Chapter 2, Cost Concepts. Learning Objectives. Understand cost classification by behavior. 2. Understand cost classification by traceability. 3. Understand cost classification by relevance. 4. Understand cost classification by function. 5. Prepare financial reports. 6. Understand and prepare manufacturing reports. Why should we classify costs? Managers plan, analyze, implement, and report control. Understanding the organization's costs help managers do all three activities better. Cost classification enables managers to better understand costs. Cost classifications by behavior. How a cost will react to changes in the level of business activity. Total variable costs change when activity changes. Total fixed costs remain unchanged when activity changes. Variable costs. The total cost of battery packs is based on the number of cars produced. The average battery pack cost per car is constant. Fixed costs. Hospital for Sick Children's monthly machine rental cost does not change regardless of how many tests are performed within a relevant range. Hospital for Sick Children's average machine rental cost per test decreases as more tests are done. Cost classifications for predicting cost behavior. Cost variable. In total variable cost changes as activity level changes. Per unit, variable cost per unit remains the same over wide ranges of activity. Fixed. In total fixed cost remains the same even when the activity level changes. Per unit, fixed cost per unit goes down as activity level goes up. Quick check. Which of the following costs would be variable with respect to the number of cones sold at a Baskins and Robbins shop? There may be more than one correct answer. A. The cost of lighting the store. B. The salary of the store manager. C. The cost of ice cream. D. The cost of napkins for customers. The answer could be both C and D. The cost of ice cream, the cost of napkins for customers. Quick check. Which of the following costs would be variable with respect to the number of people who buy a ticket for a show at a movie theater? There may be more than one correct answer. A. The cost of renting the film. B. Royalties on ticket sales. C. Wage costs of theater employees. D. The cost of cleaning up after the show. Quick check solution. The correct answer is B. Royalties on ticket sales, but it could also be C. Wage costs of theater employees. Cost classifications by traceability. How costs are assigned to cost objects. Cost object. Anything for which cost information is desired. Department, division, product, product line, etc. Direct and indirect costs. Direct costs. Costs that can be easily and economically traced to a unit of product or other cost object. Examples: direct material and direct labor. Indirect costs. Costs cannot be easily and economically traced to a unit of product or other cost object. Example: manufacturing overhead. Direct and indirect costs of an individual flight. Direct costs: flight attendants, fuel. Indirect costs, baggage handlers, ticketing staff, accounting staff. Cost object, the airplane. Cost classifications by relevance. Relevant costs. Decision makers must only use costs that are relevant to the individual decision. Relevant costs. Every decision involves a choice from among at least two alternatives. Only those costs and revenues that differ between alternatives, i.e., differential costs and revenues, are relevant in a decision. All other costs and revenues can and should be ignored. Differential costs and revenues. Costs and revenues that differ among alternatives. A retail distribution, which is current, online selling, which is proposed, and differential costs and revenues. In the decision to move from current method of selling to online selling proposed, there is a negative net income effect of $15,000. Quick check. Suppose you are trying to decide whether to drive or take the train to Portland to attend a concert. You have ample cash to do either, but you don't want to waste money needlessly. Is the cost of the pizza you ate last night relevant in this decision? In other words, should the cost of the pizza affect the decision of whether you drive or take the train to Portland? A. Yes, the cost of the pizza is relevant. B. No, the cost of the pizza is not relevant. Quick check solution. B. No, the cost of the pizza is not relevant. Quick check. Suppose you are trying to decide whether to drive or take the train to Portland to attend a concert. You have ample cash to do either, but you don't want to waste money needlessly. Is the cost of the train ticket relevant in this decision? In other words, should the cost of the train ticket affect the decision of whether you drive or take the train to Portland? A. Yes, the cost of the train ticket is relevant. B. No, the cost of the train ticket is not relevant. Quick check solution. A. Yes, the cost of the train ticket is relevant. Quick check. Suppose you're trying to decide whether to drive or take the train to Portland to attend a concert. You have ample cash to do either, but you don't want to waste money needlessly. Is the annual cost of licensing your car relevant in this decision? A. Yes, the licensing cost is relevant. B. No, the licensing cost is not relevant. B. No, the licensing cost is not relevant. Suppose you're trying to decide whether to drive or take the train to Portland to attend a concert. You have ample cash to do either, but you don't want to waste money needlessly. Is the depreciation on your car relevant in this decision? A. Yes, the depreciation is relevant. B. No, the depreciation is not relevant. So it could be A, depreciation that is a function of kilometers driven would be relevant. But then it could be B, depreciation that is a function of the passage of time would not be relevant. Opportunity costs. The potential benefit that is given up when one alternative is selected over another. Example, if you were not attending college, you could be earning $30,000 per year. Your opportunity cost of attending college for 1 year is $30,000. Sunk costs. Sunk costs cannot be changed by any decision. They are not differential costs and should be ignored when making decisions. Example, you bought an automobile that cost $10,000 2 years ago. The $10,000 cost is sunk because whether you drive it, park it, trade it, or sell it, You can't change the $10,000 cost. Quick check. Suppose that your car could be sold now for $5,000. Is this a sunk cost? A. Yes, it is a sunk cost. B. No, it is not a sunk cost. B. No, it is not a sunk cost. Cost classifications by function. Value chain. The series of steps that every organization carries out to fulfill its mission. The activities within these steps are performed by the various functions within the organization. Value chain example: plant cultivation, seaweed harvesting, product and application development, production, marketing, customer support. Comparing merchandising and manufacturing activities. Merchandisers buy finished goods, sell finished goods. Manufacturers buy raw materials, produce finished goods, sell finished goods. Manufacturing costs, the product. Direct materials, direct labor, manufacturing overhead. Direct materials. Those materials that become an integral part of the product and that can be easily and economically traced directly to it. Example: metals used to make an automobile's bodywork. Direct labor. Those labor costs that can be easily and economically traced to individual units of product. Example: wages paid to an automobile assembly workers. Manufacturing overhead. Manufacturing costs that cannot be easily and economically traced directly to specific units produced. Indirect labor, indirect materials, and costs incurred to run a factory. Wages paid to employees who are not directly involved in production work. Examples: maintenance workers, janitors, and security guards. Materials used to support the production process. Examples: lubricants and cleaning supplies used in the automobile assembly plant. Costs incurred to run the factory. Examples could be rent, utilities, and maintenance. Classifications of costs. Manufacturing costs are often classified as follows: direct material, direct labor, and manufacturing overhead. Direct materials plus direct labor equals prime costs. And direct labor plus manufacturing overhead is also referred to as conversion costs. Non-manufacturing costs. Marketing and selling costs. Costs incurred to secure orders, deliver the products to customers, and follow up with them. Examples could be advertising, sales commissions, and salaries. Administrative costs. Costs associated with the general management of the company, all executive, organizational, and clerical costs. Examples: company president's salary, office supplies. Quick check. Which of the following costs would be considered manufacturing overhead at Boeing? More than one answer may be correct. A. Depreciation on factory forklift trucks. B. Sales commissions. C. The cost of a flight recorder in a Boeing 767. Or D. The wages of a production shift supervisor. So it could be A. Depreciation on factory forklift trucks. Or D. The wages of a production shift supervisor. Product costs versus period costs. Product costs include direct materials, direct labor, and manufacturing overhead. Inventory is on the balance sheet. When you sell it, it goes into costs of goods sold, which is on the income statement. Period costs are not included in product costs. They are expensed on the income statement directly. It's an expense on the income statement. Quick check. Which of the following costs would be considered a period rather than a product cost in a manufacturing company? A. Manufacturing equipment depreciation. B. Property taxes on corporate headquarters. C. Direct materials costs. Or D. Electrical costs to light the production facility. Quick check solution. Which of the following costs would be considered a period rather than a product cost in a manufacturing company? B. Property taxes on corporate headquarters. Cost classifications on financial statements. The balance sheet. Merchandiser, current assets, cash, receivables, prepaid expenses, merchandise inventory. With the manufacturer, with the current assets, we also have cash, we also have receivables, we also have prepaid expenses, but we have 3 different inventories. 1 is raw materials, 2 is work in process, and 3 is finished goods. Balance sheet manufacturer, inventories, raw materials, materials waiting to be processed. Work in process, partially complete products, some material, labor, or overhead has been added. Finished goods, completed products awaiting sale. Cost classification on financial statements, the income statement. Merchandising company. So this is the part of cost of goods sold if we open it up. We have beginning merchandise inventory, add your purchases, that equals goods available for sale. You subtract your ending merchandise inventory, and that equals your cost of goods sold. With a manufacturing company, to calculate your cost of goods sold, you start with your beginning finished goods inventory, and then you add in your cost of goods manufactured, and that equals your goods available for sale. Then you subtract out your ending finished goods inventory, and that equals your cost of goods sold. Quick check. Which of the following transactions would immediately result in an expense? There may be more than one correct answer. A. Work in process is completed. B. Finished goods are sold. C. Raw materials are placed into production. D. Administrative salaries are incurred. Quick check solution. It could be B. Finished goods are sold. Or D. Administrative salaries are incurred. Inventory flows. Generic costs flow through an inventory account. Inventory beginning balance. Add additions to inventory. That equals inventory available for sale. Subtract withdrawals from inventory, and that equals your inventory ending balance. Inventory flows. Beginning balance plus additions equals available. Then, available minus withdrawals equals ending balance. Quick check. If your bank balance at the beginning of the month was $1,000, you deposited $100 during the month and withdrew $300 during the month, what would be the balance at the end of the month? A, $1,000, B, $800, C, $1,200, D, $200. The answer is B, $800. So it's the 1,000 plus the 100, and then it's the 1,100 minus the 300. Inventory cost flows and costs of goods sold. Merchandising. Schedule of cost of goods sold. Beginning merchandise inventory plus purchases equals cost of goods available for sale minus merchandise ending inventory equals cost of goods sold. Manufacturing and merchandising on the income statement. Sales minus cost of goods sold equals gross margin minus your operating expenses equals net income. Manufacturing. The schedule of cost of goods sold is actually we should start over here. The schedule of direct materials used is your direct materials inventory beginning plus purchases equals your direct materials available for production. Then subtract your direct materials ending inventory. That gives you your direct materials used. So then we look into the schedule of cost of goods manufactured. So within our work in process inventory account, we have direct materials plus direct labor plus manufacturing overhead. That gives us our total manufacturing costs. When we add in our work in process beginning inventory and subtract out our work in process ending inventory, that gives us our cost of goods manufactured. And then we can go over to the schedule of cost of goods sold. And in our finished goods inventory account, we can start off with our beginning finished goods inventory, add the cost of goods manufactured. That will give us our goods available for sale. Subtract out our finished goods ending inventory, and then that gives us our cost of goods sold. Schedule of cost of goods manufactured. So we can take our direct materials, our direct labor, and our manufacturing overhead. Those three together equals your total manufacturing costs. Then when we add the work in process beginning inventory and subtract the work in process ending inventory, it gives us our cost of goods manufactured. Product costs, a closer look. Manufacturing cost flows. Costs, product costs, raw materials purchases, direct labor, and manufacturing overhead. The raw materials go into the raw materials inventory account on the balance sheet. When they are used in production, they're moved into the work in process inventory account. Direct labor is directly put into the work in process inventory account from payroll. And manufacturing overhead is allocated to the work in process inventory account using a predetermined overhead rate. That's where we can calculate the cost of goods manufactured that's transferred into finished goods until we sell it and becomes cost of goods sold on the income statement. The period costs, selling and administrative, they just go directly on the income statement. So they bypass any inventory accounts. Product costs, a closer look at raw materials, part 1. Beginning inventory is the inventory carried over from the prior period. Product costs, a closer look at raw materials, part 2. As items are removed from raw materials inventory and placed into the production process, they are called direct materials. Quick check. Beginning raw materials inventory was $32,000. During the month, $276,000 of raw material was purchased. A count at the end of the month revealed that $28,000 of raw material was still present. What is the cost of direct material used? A. $276,000. B. $272,000. C. $280,000. D. $2,000. The answer is C. $280,000. Product costs, a closer look at conversion costs. Conversion costs are costs incurred to convert the direct material into a finished product. Quick check. Direct materials used in production totaled $280,000. Direct labor was $375,000, and factory overhead was $180,000. What were total manufacturing costs incurred for the month? A, $555,000, B, $835,000, C, $655,000, or D, cannot be determined. The answer is B, $835,000. Product costs, a closer look at WIP inventory, Part 1. All manufacturing costs incurred during the period are added to the beginning balance of work in process. Product costs, a closer look at WIP inventory, Part 2. Costs associated with the goods that are completed during the period are transferred to finished goods inventory. Quick check. Beginning work in process was $125,000. Manufacturing costs incurred for the month were $835,000. There were $200,000 of partially finished goods remaining in work in process inventory at the end of the month. What was the cost of goods manufactured during the month? A, $116,000, B, $910,000, C, $760,000, D, cannot be determined. The answer is C, $760,000. Product costs, a closer look at cost of goods manufactured. So the cost of goods manufactured is transferred out of work in process when it's complete and into finished goods when it's waiting to be sold. Quick check. Beginning finished goods inventory was $130,000. The cost of goods manufactured for the month was $760,000, and the ending finished goods inventory was $150,000. What was the cost of goods sold for the month? A, $20,000, B, $740,000, C, $780,000, D, $760,000. So the correct answer is B, $740,000. Chapter summary. Costs can be classified in many ways depending on the information that a manager needs. A cost can be classified by behavior, by traceability, by relevance, or by function. While the income statements look similar for merchandising and manufacturing companies, the cost of goods sold calculation is different. This is because manufacturing companies make their products, whereas merchandising companies buy the products they sell. Manufacturing companies must calculate the cost of goods completed by preparing a schedule of costs of goods manufactured. This schedule includes direct material used, direct labor, and manufacturing overhead, along with an analysis of work in process inventory.